Okay, all right, so chapter 10. All right, hang on a minute. Gotta figure out how to. All right. There we go. Okay, so chapter 10. All right. So we've essentially spent the last, 2 weeks basically summarizing and reviewing balance sheets and income statements. Okay. So now we're backing up to chapter 10, or actually we're going to the end of chapter 10, and we are going to look at some ratio analysis of the balance sheet. Okay. So this is the kind of stuff that when you produce a set of financial statements and you take it to the bank and the analysts look at it, the bankers look at it, and they decide whether or not they're going to loan you money, or you see the investors do the same thing here, where if you want to invest in a company, you do these same ratios to try to decide, do you want to invest your money? Okay? So here's your competencies for this chapter, all right? The first two ratios. Now let me just say, again, not a big fan of this author. Okay, so summary, I like keeping things simple, categorizing it, and then thinking about what's happening there. This guy, he just likes to sort of mishmashing, putting things in. All right, so the first two ratios that we're going to look at are the current ratio and the quick ratio. Okay, so at this point, the only section of the balance sheet that we're looking at is the current asset section and the current liability section of the balance sheet. Okay, so hang on one second. All right, so we're on page 279. So again, take a look. We're only dealing with accounts that are under that current asset section and that current liability section. Okay, that's it. That's the focus. And the focus for these two ratios as well is what we call liquidity. Okay, now remember, liquidity means how quickly is it going to turn into cash, or how quickly is it going to be a payment out of cash. Okay, because remember, the most important thing in your business is cash flow. We run out of cash, we shut the doors. Okay? So again, we're going to look at these two ratios. This is going to measure the company's ability to pay its current obligations. Okay, that's accounts payable, based on the idea that a company gets its cash flow from current assets. Okay? So if everything for our cash flow comes in on current assets, all the cash flow going out is going to be for current liabilities. Okay? That's sort of the idea there. Okay? Operational cash flow. Okay? So let me go ahead and make one point here. You might be thinking, well, gosh, we could have cash flow from loans. Yes, but that's not operational cash flow. Okay? So if you remember, if you go back to the cash flow statement, you've got three different sections of the cash flow statement: operating, financing, and investing. We're looking at operating cash flows. Okay? So what do we do and how do we earn that cash? All right? So the current ratio is pretty simple. Okay? We're simply going to take total current assets and we're going to divide by total current liabilities. All right, so if we're looking at page 279, what numbers would we use there for 2000x2? Okay, the 147,888 divided by well, there's only one issue there. We wouldn't use the 123,750. Oh, yeah, we need to use a different number because we don't want to include notes payable. Okay. All right. So again, gives us an idea many dollars we have in current assets paid off each dollar of current liabilities, okay? So, think about what's happening here. Let's say that this ratio gives us a ratio of 3, okay? So, what we're saying is for every dollar in current liabilities, we have $3 in current assets, right? If we got a ratio of 1.5, we would be saying for every dollar in current liabilities, we would have $1.5 in current assets, okay? So, anything here, the bank standard is 2. So what the bank wants to see is at least $2 in current assets for every dollar in current liabilities, because they know that there are other things that are sitting out there that we're going to have to pay other than our accounts payable, okay, and our other current liabilities, like bank loans, okay? All right? So, you can see the bank standard is greater than 2. Now, let me make this note here. Don't get this idea in your head that 2 is good, okay? This is a minimum standard from the bank, okay? So, do not manage your business based on the minimum bank standard, okay? This ratio really needs to be for comfortable purposes so that you don't have accounts payable folks calling you constantly wanting cash and needing money and all that kind of stuff. This really needs to be somewhere around a 3, if not higher, okay? So that you can be paying your bills, you've got a little extra cash left over, and you're not feeling like you're choking half to death, okay? So again, don't use this 2.0 bank standard as thinking that's good. That's a minimum, okay? All right, let's take a look at the next one. All right, quick ratio, all right, we're going to take cash plus the short-term investment. So look at the current asset section. We're going to take cash plus the short-term investment plus the net receivables, okay? And that's it, okay? So what is the commonality of those 3 items on this balance sheet? What do they have in common? Can you tell? They're the highest liquidity, right? Okay, so remember from last semester when we were looking at putting our balance sheets together, remember the current asset section goes in order of liquidity. So cash, the short-term investments, and the net receivables are the first 3. Okay, so they are absolutely of the highest liquidity. We still use total current liabilities. Okay, so here, what this one is doing is this one is sort of a backup of if the crap hits the fan, right? And we had to really work on getting some cash in to get somebody paid. How quickly could we do it? Okay, so again, gives us an idea how many dollars we have in current assets to pay off each dollar of current liabilities in general, okay? But it excludes the less liquid current assets like inventories and prepaid assets, okay? Because again, remember, because inventories, we've got a hold of those, now we've got to get them sold and we've got to collect. So not very liquid when we're talking about inventories. And then on the prepaid assets, remember, prepaid assets, that's the kind of thing where maybe we had to pay 6 months worth of insurance in advance. So unless we want to cancel our insurance altogether, the liquidity of a prepaid asset, like a prepaid insurance or prepaid rent, not very liquid, right? Because we would literally have to move out and not owe that rent, or we have to completely cancel our insurance get that cash back. Okay? So, therefore, again, higher ratio is better. And again, this ratio is going to give you something like a 2.0, a 3.0. And again, it's for every dollar that we have in current liabilities, how many dollars do we have in highly liquid assets to be able to take care of those current liabilities. Okay? Now, on this one, the bank standard is greater than 1. Okay? Now, if you look back and compare these, bank standard here is 2, bank standard here is 1. Okay? Now, the fact that we're removing some of those current assets from this ratio should make sense that the standard on this one is a little bit lower. Okay? All right. So, any questions on those? So, again, those two ratios, we're assessing liquidity. How quickly can we get somebody paid if we need to? All right. All right, here we go. All right, so here's a comparison of this one as well. So here's our current ratio. We've got two different companies. Now let's talk through what the differences are in these two companies. All right, one, the similarity is they both have total current assets of $200,000, right? They both have total current liabilities of $100,000. So what is their current ratio? 2 to 1, right? So, now keep in mind, this is a little snapshot from the book. A current ratio, you wouldn't see the colon 1. The current ratio for both of those would be 2, okay? Because we have $2 in current assets versus the $1 in current liabilities, okay? But here's the big difference between the two. Now, if we start really taking apart the individual accounts and the individual balances for each one of those groupings for our current assets, look at Company B. We've got a lot less cash there. We've got no short-term investments at all, but we've got a fairly high accounts receivable. Okay? The other thing is we've got pretty high inventories in Company B and same prepaid expenses for both companies. So when we go to put together a quick ratio in this particular case, the quick ratio for Company A is 1.45, Company B is 0.95. All right? So here's the question. If both companies went to the bank to borrow money, who's going to get the loan? A or B? A is going to get the loan. B is not going to get the loan because they do not even meet the minimum standard on the quick ratio. We take the 100,000, 25, and 20, then divide that by 100,000. Okay.
But Company A doesn't need to minimum either. It doesn't have a 2.0. So would they be automatically out of the running?
No. They do have a 2.0. It's just if you take the 200 divided by 100 for our current assets over current liabilities, you get a 2. Mm-hmm. Same thing over here for Company B. You get a 2.
Right.
So they both meet the minimum standard for the current ratio, but only A meets the minimum standard for quick. Okay? What do you mean when the numbers don't match up? Well, what they're trying to tell you on this current ratio, that it really should show just a 2, okay? Because you could have a ratio of 2.1, 3.3, 4.5, right? And that's what the actual math is going to give you. But remember, again, to interpret this ratio, we're determining that for every $1 of current liabilities, we have $2 just know when you do your math, 200,000 divided by 100,000 just gives you 2. Okay. This is more for interpretation purposes. On the homework, just give me the number, not a colon 1. And just realize that on every calculation on the colon, it's always going to be colon 1. Because it would be like $3.3 per $1 of current liabilities, or $4.5 of current assets to every $1 in current liabilities. All right. So again, we're trying to interpret cash flow, cash management. How well are we paying our bills, or capable of paying our bills? All right. The next 4 ratios are all about asset management. Okay. So for every dollar that we have invested in some kind of asset, how well are we doing with earning money? Okay. So we're going to look at 4 different ones, and they're going to assess the asset management in a slightly different way. Okay? So let's take a look at the accounts receivable turnover ratio. All right? Now, before we look at the math, okay, let's drop down to the bottom. It measures a company's ability to collect its accounts receivable or sales in a timely manner. Therefore, a higher ratio is better. Okay? So, now, one thing to keep in mind, if you're a cash business, this is not really a ratio that you can assess simply because 100% of your sales are collectible, and you would always have accounts receivable of 0. Okay? So let's move that off the board. So only a company who sells on credit is going to be able to assess accounts receivable turnover ratio. Okay? So again, how quickly the sale has been made. So how long does it take from the point of sale to the collection of that sale? All right? So the first thing is we're going to look at net revenues. And notice it's net credit sales. Okay, again, we're not going to include cash sales in this. Okay, and then we're going to divide it by average accounts receivable. Now, average accounts receivable is a really simple average. It's not a weighted average. It's simply beginning accounts receivable plus ending accounts receivable for the period that we're assessing divided by 2. So, if we're assessing the accounts receivable turnover ratio for, let's say, December 2016, we would start with the beginning accounts receivable at December 1 plus the accounts receivable at December 31 divided by 2 to get our denominator. Okay? Then the numerator would only include the revenues for December. And again, credit sales for December. Okay? To get an accurate number. Okay? If we wanted to assess this ratio for, let's say, a quarter, so let's say that we wanted to assess this ratio for 4th quarter of 2016. We would include credit sales from October 1 to December 31. So we would include October, November, December for our credit sales. Then for our average net accounts receivable, it would be beginning accounts receivable at October 1, ending accounts receivable at December 31 divided by 2. Okay? So whichever time period we're looking at, we've got to make sure that we are including the correct revenue for that time period, and then we need to make sure that we include the beginning and the ending accounts receivable at the correct time periods. Okay? Otherwise, your ratio is going to be out of whack. And if I remember correctly in the book, he presents this as like multiple ratios. It's the same exact ratio regardless of the time period that you're assessing. Okay, although he presents it, I believe, as the time period changes the ratio. It doesn't change the ratio. It just changes the number that you're using. You need the second one to find the first one. Okay, because this second calculation here for the average net accounts receivable, you've got to make sure that you calculate that and plug into your denominator. Okay. All right. So when we are looking at an accounts receivable turnover ratio, again, remember we are assessing how long it's taking us to go from point of sale to collection. So the quicker we actually collect, the higher the ratio here. Okay? Because the higher the sales, the lower the accounts receivable. Okay? Does that make sense? Okay? So again, higher ratio is better. So the turnover ratio is actually going to give you the number of times that we actually sell, collect, sell, collect, sell, collect. Okay? So it's going to give you something like, let's say that we were putting this on an annual basis. And let's say that we ended up with an accounts receivable turnover ratio of 12. Okay? So what that's saying is that on a ratio for 12, that means that we're essentially collecting once a month, right? We collected 12 times during the year. If we had a accounts receivable turnover ratio of 52, how often do you think we're collecting? One every week, right? If we had a ratio of 26, we're collecting every other week, right? Okay, you get the idea? All right. So let's take a look at the next one, because this ratio affects the next one. So now we're looking at average collection periods. So what we're doing is we're simply converting the accounts receivable turnover ratio of number of times per year to number of days. So again, think about what's happening here. Our accounts receivable turnover ratio was 12, okay? Then it would equate to approximately 30 days, right? If we had a turnover ratio of 52, we would be collecting every 7 days. So instead of thinking it through as once a month or once a week or once every 2 weeks, we're actually converting it into number of days that period is taking place. Okay? So those two are connected together. You can't do collection period ratio without calculating the turnover ratio first. Okay? Personally, I like this one better because I like the more visual number of days. How long are we collecting? All right. Let's see. Actually, let me back up here. One other thing to note here, when you're talking about the turnover ratio or the average collection period ratio, is depending on what your operating cycle is, this really, 30 days is about the max that you want to do there, okay? Because if it goes over 30 days, that means that the folks that you're selling to are not paying you on a timely basis. So if you went to the bank and your average collection period was running somewhere between 45 and 90 days, that means that the people that you're selling to are paying slow. Okay, that's not good, right? Because you've got your monthly bills that you need to be paying, and most bills sort of run on a monthly basis. So again, once we get over 30 days or a turnover ratio of 12, we got a problem. Okay. All right. Everybody good there? Okay. Next one, we've got an inventory turnover ratio. All right. Now, when we're talking about an inventory turnover ratio, now we're backing up in the sales cycle. We're talking about receiving the inventory to a sale period, okay, versus the accounts receivable turnover ratio went from the sale to the collection. Now we're backing up in the cycle and we're going from receipt of inventory to sale. All right, so in this one, we're going to take cost of food or beverage used, okay. So again, remember, cost of food or beverage used is beginning inventory plus purchases minus ending inventory. Okay, so that's going to give you your calculation for your numerator. Okay, then we're going to divide that by average food or beverage inventory. So again, average inventory, beginning inventory plus ending inventory divided by 2. Okay, so how well are we using our inventory? So again, the more often that we have to take delivery and sell, the better. Okay? Now think, in the restaurant industry, food inventory, give me an idea. How many times per year do you think that the arrival of the inventory to the sale should take place? How many times a year do you think? You know this. All right. In a restaurant situation, how often should you see the arrival of inventory to the sale? Exactly. It should be about every week, right? Okay. So if it's about every week, how many times per year should you see your inventory turnover ratio? 52. Does that make sense? So in the restaurant industry, we're talking about food inventory specifically, especially when you're talking about fresh food, okay? I'm not talking about like a McDonald's that gets their burgers in, frozen, and all that kind of stuff, right? All right? Fresh food, you should have a turnover ratio of 52, all right? But let's say that our restaurant has a bar, okay? And let's say we're talking about beer and wine. What do you think the inventory turnover ratio should be for beer and wine? Does it have to be every week? How often do you think? Maybe every 2 weeks, right? What if we were talking about liquor? What would be our turnover ratio? Maybe monthly, right? So if we're talking about food, this turnover ratio should be somewhere around 52. If we're talking about beer and wine, this ratio should probably run somewhere around 26. If we're talking about liquor, probably going to run somewhere around 12. Okay? So it depends on what the nature of the inventory is as to what you're going to get on your turnover ratio. Okay? And again, better if each department's inventory is evaluated separately, because again, the difference between the longevity of fresh food versus beer and wine versus liquor, very, very different. Okay? Again, when you got your turnover ratio, okay, if you want to convert it to an average turnover period, okay, you do use it the same way as the average inventory, accounts receivable ratio. So you simply take that turnover ratio divided by 365. So instead of it being 52 times a year, it becomes 7. Instead of it being 26 times a year, it becomes 14 days. Instead of it being 12, it becomes somewhere around 30 days. Everybody good there? So again, when we're talking about inventory turnover ratio, it's from the arrival of the inventory to the point of the sale. All right. You know what? It's about 25 after. Let's go ahead and take a break. So let's be